Hello and welcome to another episode of Darwin Investors. Well, there's an old saying out there that says that you think you're smart in a bull market because everything you buy just kind of goes up and you just keep making money and everything's good. But you actually get smart in a bear market because you learn that the market isn't always going to come to you. Sometimes you have to go out and get that money. Now, for me, during the bull market, I learned stuff like price to earnings ratios, price to sales. I was able to look at I learned how to look at 10Qs, free cash flow, and things of that nature to know when I'm actually looking at a well-priced company. So I still use those strategies and I still buy those kinds of stocks. However, I have learned that the market isn't always going to come to me. It's not as simple as just buying the stock and then cashing out on the stock a couple weeks later and making some money. Sometimes the stock goes down and I still have to find a way to get that money. And shout out to the people that are watching these videos and subscribing. I never thought it would get this big of a channel, if I'm honest. Even though it's still really small, to me, it's bigger than I ever thought it would get. I actually had one of my coworkers, she comes up, my husband's watching your channel. He's made $1,900. Now he wants to start doing day trading. I'm like, no, not day trading. I'm not a day trader. I am a trader, but I do employ risk management strategies. I do kind of mentally, if not actually physically, write down my max risk when I'm making these trades to try and make sure that I had given myself the best chance to win. And when I do lose, it's small enough that I can actually make that money back. And that's what this video is going to be about, because a couple of weeks ago, I got squeezed out of some covered call positions. Now, you don't automatically have to just like roll the call up and out. There are a lot of different ways that you can try and get your money back. And those are the strategies we're going to go over now, using the options that got squeezed out of just a couple of weeks ago as an example of how to do these things. I'll also show you my current positions and what I have planned for the market going forward based on what I believe is the direction that the market is headed. And last but not least, now that once we understand really well, at least my idea, my thinking on option strategies, there's one company out there I think when they report earnings is going to be a dumpster fire, and I'm going to show you that how I plan on profiting from this, and I'll do that at the end of the video, and what my strategy is going to be to limit my risk to almost nothing, if I'm honest, but maximize my gain and try and make $1,000 on this dumpster fire. All right, so let's get into this. So what I'm going to list here is 6 ways that you can get your money back once you've been squeezed out of your covered call positions. And the first way is just to do nothing. As an example of doing nothing, let's take a look at the current positions that I have open now. Now I've got a whole bunch of covered calls open. I have one put on semiconductors that they report on Monday. And I also have this UPS position. It's a covered call position that says that if UPS is over $190, by the 5th of August, I will collect $61. I'm currently down $537 on this position because as a part of Amazon reporting such good earnings, UPS went up with their earnings. They may be part of the same ETFs or what have you, or maybe they just see a strong correlation between one and the other. But nevertheless, UPS went screaming up on Friday to about $195, meaning that now if I want to buy my way out of this contract, it would cost me $537. I'm in a sense being squeezed out of this contract. But why would I do anything about this contract? Because when you look at my UPS position here, you can see that my cost basis on UPS is $195. However, I've also sold a lot of options on UPS against that position. So what that does is it brings down my cost basis on UPS. I have 100 shares of UPS. I've sold an awful lot of contracts on it. My new cost per share, my new cost basis is $188.24. So if my cost basis is $188.24, why on earth would I buy my way out of a contract that guarantees me $190 for $537? I wouldn't. So I wouldn't mind actually just getting this money back and basically adding it to the war chest and preparing for the market's next trip downward, because that could happen. So that's one strategy that you can do. You can just do nothing, and I'll just collect my $61, sell my shares, add $19,000 to the war chest, and get ready to put that money somewhere else. Maybe back into UPS if they go down to like 180. I'll buy them back, I guess, if that's what I really want to do. Or maybe I put it somewhere else. We never know how these things are going to work out. Now, the next thing you can do is the most important thing. If you're get squeezed out of a covered call position or any position, and you're trying to get your money back for that position, this is the most important thing. And I'm going to give some examples of that right now. And the most important thing you can do is look for opportunities in a different stock. You do not have to get your money back right where you lost it. If the market is screaming upward, why would you sell another covered call against that same position that is still screaming upward? Now, maybe you sell a put on that same underlying equity. Maybe you sell another covered call because you think it's reached the limit. But by and large, when I lose a lot of money or lose some money on something, the first thing I do is I look all over the market and I think, what stock gives me the best chance of getting this money back, and how do I do it? That's the first thing that goes through my mind. So let's look at the money that I lost because the market went up unexpectedly a couple of weeks ago. Let's look at the money that I lost that week on my covered call positions, and let's look at what I did to get that money back. So we can see right here from July 18th through July 22nd, that was 2 weeks ago. This is the week we just had, a great week. But 2 weeks ago, we also had a really great week. In fact, this was the best month the S&P has had since, I think, November 2020 or something like that. It's a long time ago. So this is the best month we've had in a long time. So of course I was losing some money on covered call positions, because a covered call position means you think that the stock market's actually going to go down. And on this week, I lost $579. Now I will tell you that in the week that followed, I ended up making $929. For the month, I ended up making $1,277. And for the year on my options, I'm up about $10,000. Now that doesn't seem like a ton, but remember the market's actually been down, and yet on these options trades, I'm up $10,000. And somebody may think that's a lot of money, and somebody may think that's nothing. For me, that's a lot of money. I think $10,000 is a lot of money. And actually my account now, because it's been screaming up for a month, I'm only down 3.5% for the year. Now, the S&P is down about 15 or 16%. The NASDAQ's still down over 20%, and I'm only down 3.5%. Now, a lot of that is because of these options. A lot of that is because I put in money every couple of weeks. But let's go ahead and have a look at the trades that were made during that week where I was losing money in options, but I was making just thousands on unrealized gains during that week. So that's what it means when you're losing money, getting squeezed out of your covered call positions. So this was a very busy week. So I was down $579 for the week on all these positions. On AMD, I got squeezed out, and it cost me $198 to buy that contract back. And there was a covered call here for Amazon that cost me $209 to get that back. There was a covered call for NVIDIA that cost me $415 to get that back. You can already see that I got some of this back, because I only ended up losing $579 that week. However, this is about $700, maybe $800 worth of losses there. And Lowe's did me dirty. The Lowe's was the ultimate squeeze job. I lost $581 on Lowe's that week from getting squeezed out of that position. And believe me, I wasn't the only one. Like Lowe's, for no reason at all, the whole market was down on that Friday, and for no reason at all, Lowe's screamed up to $198. I'm like, what gives? It's just basically a whole bunch of us getting squeezed out, causing that stock to go up. But the ones we're going to focus on here in this video are going to be AMD, Amazon, and NVIDIA. Now, when I got squeezed out of all of these positions and I was down all this money, the immediate thought is, well, let me go back and get it with them. But that's not the first thing that I thought. The first thing that I thought was the risk in this market. If you look at the S&P 500 from last week or a couple of weeks ago, The risk in this market was actually to the upside. I thought the market would continue upward. So what I wanted to do then was go find deals and sell puts against them because I think the market's going up and I'm going to sell puts way down here. And it doesn't have to be on the same equities. It could be on different ones. So what I did was I sold a bunch of puts, and selling a put means that, let's say here on Google, they reported earnings. I sold 4 put contracts. I said, if Google finishes below $99 on the 29th of July, then I will buy 400 shares of Google for $99 each. If it finishes above $99, you will pay me, in this case, $369. I closed it out a little bit earlier and only made $349. So I sold a put on Google. I also sold a put on Honeywell. This would be an example of going out of the box a little bit. Honeywell, I had a good feeling about because of their aeronautical division. They sell, commercial avionics parts. They do like auxiliary power units, avionics, lighting, navigation sensors, radios, and the like. They got a pretty big avionics department. GE just reported in their avionics department did really super well. Because GE's avionics did so well, I was thinking that Honeywell's avionics would do well because Honeywell's a better company than GE anyway. Darius Sandemchik is a fantastic CEO. This is a great company. And they actually do factory robotics and they do a lot of things. They're a very tech oriented company. And plus with people going back to work, I figured heating and air conditioning would be coming back in a bigger way for Honeywell. So I was pretty bullish on Honeywell going into this. So I actually sold a put on Honeywell. I'm also was bullish on NXPI because automotive semiconductors are a pretty big thing right now. Car manufacturers can't get them fast enough. They can't manufacture them fast enough. It's the reason why Taiwan Semiconductor did so well. Was because of their automotive semiconductor production capacities. And NXPI, that is their bread and butter. We have another one that's going to be reporting on Monday morning on semiconductors. I just could, when I saw what was coming up next week and I saw on semi, my eyes about popped out of my head. I'm like, yeah, I'm selling puts on those. That's going to be a good one. I also sold puts on UPS and I sold a put on Visa. Visa was funny because as soon as they reported earnings, it was kind of flat, even though they were 19% year over year with their revenue increase and 30% with their net income. However, the stock market reaction to all this was pretty muted. And then in fact, the next day it dove down and I quickly looked and said, why on earth would this dive down like this? I was trying to find some information anywhere and I couldn't find anything. And when I couldn't find anything, I just went ahead and sold a put on Visa with a $202 strike that expired at the end of the week. And then I cashed out on that one, I think about 30 minutes later because it quickly bounced back. So I made $70 in about 30 minutes. And then Amazon, I closed out this covered call position on Amazon with a $135 strike, and I made $40 on that. Now, this was the day, you may remember, that Jay Powell was going to come out and raise interest rates 75 basis points. Now, I know that from the past that whenever Powell speaks and raises interest rates, the market shoots upwards for some reason. And then the next day, traditionally, it didn't happen this time, but traditionally the next day, the market will take a breather and go back down. So what I did was I sold all these puts, and then Jay Powell gave his speech, sent the market upward. I should be wearing my Jay Powell shirt right now, actually, but sent the market upward. I waited about an hour and then I sold a whole bunch of covered calls thinking the next day it would crash and I'd be able to cash out all these things on Friday. That didn't happen, which is fine by me. I ended up still making money. On Friday, I ended up, I did sell out a lot of my covered call positions because I sold them way out of the money, but I ended up only making $42.49. But hey, I had a great week. And then I ended up making money in my options, and I had made money in options overall for the month. Even though I'm selling a lot of covered calls, I still made money for the month with the market going up at the same time. So I'm learning, I'm learning this art. And so just got to pick your spots. As a matter of fact, one of the spots that I picked this past month when I was talking about looking for opportunities was in Caterpillar. And because I looked at Caterpillar was sitting about $172. It's now about $200. but it was sitting about $172 at the time. It had a chart that was just like standing it straight down. I tried to find some information on it to figure out why Caterpillar was so far down. I couldn't figure it out. So, I ended up selling puts on them starting on the 20th, cash out on the 22nd, sell a put with a $170 strike. For 73 bucks, bought it back the next day for $35. I didn't even have to wait for earnings. They're reporting earnings next week, but I just couldn't quite wrap my head around why Caterpillar would be so far down. I know they're part of the housing industry. I know China's shut down. They do a lot of business over there. But at the same time, this stock was trading so cheaply. This would be one of the places I would look to get my money back when trying to recoup some of my losses from being squeezed out of my covered call place. So these are all examples of what I would do to get my money back for looking for opportunities in a different stock. Now, the next one is the ever popular roll the call up and out. Now, this is going directly back to try and get your money back from the same stock that you lost in. And I'm not saying don't do this. I'm just saying that I rarely do this because it ties up my money for a long time. But using this as an example, let me go ahead and show you how to roll a call up and out and get your money back that way using the NVIDIA example. We can see here that NVIDIA, I had a covered call where a strike price of 172.50 that expired on July 22nd. You can see that I lost $415 on that. NVIDIA is currently sitting at about $180 or so, $181. So to roll this call up in price and out in time, I would have to do it over $181, at least for this example to show you how this would work. But the goal is I need to get my $415 back. And so for NVIDIA, it's sitting at 181.63. If I roll this out in time to August 19th and up in price to $190, I can collect $4.85 a share or $485. So I bought it back for $415, but I can resell it for $485, giving me a net of $70. That is one way to do it. And it's not a bad way. It's a very common way to do it. And in doing this, I want to show you something that's very interesting here. Here's AMD. Now, AMD reports earnings next week. When you're dealing with options, one of the things you're dealing with is volatility or vega. And so because they're reporting their earnings next week, their vega or volatility is very, very, very high. So I can actually sell a covered call on AMD out of the money for much more money than I would normally get out of them due to volatility, because much of what you're paying for, at least all of what you're paying for when you're doing it out of the money, is extrinsic value would be time to maturity and the implied volatility. Now, because it's before earnings, this thing is very volatile. For this, even though it's $3.50 out of the money, I could get $219 in premium. I could actually sell this thing all the way out to say $105 and still collect $63 in premium, because people don't really know which direction AMD is going to go in. Now, I personally am not sold a covered call on this. My play instead is going to be wait and see what happens, and then I suspect it's going to move up, and when it does move up, that's when I'll sell another covered call against it. That's what I did with Amazon, because I figured it would go up on earnings, and as soon as it spiked, sell another covered call. But I digress. So we'll go back to NVIDIA. So you can roll the call out in time and up in price and collect all your money back. Now, the next way is to create a strangle at the expiration date. And what that means is sell one up, but not out in time, and then sell a put against this equity at the same expiration date and try and get a little bit of your money back. And in fact, this is what I did. So what I ended up doing to get my money back was a combination here. I looked for opportunities in different stock, and I strangled at the current expiration date. So let me go ahead and show you what I mean by that. To keep this nice and simple, you can see I was squeezed out of AMD, Amazon, and NVIDIA. And so when I look at my transaction history, let's use NVIDIA as an example here. I was squeezed out of my position on the 20th, and it cost me $445. Now, I'm only down currently on NVIDIA $233 since the 20th on options. And then what I did eventually was immediately afterwards, I closed this out and then I sold a covered call with a $185 strike that expired on the 22nd of July. And I sold that for $96. So you can clearly see I wasn't trying to get back the entire 445 at the time. And then I waited a little bit of time for NVIDIA to come back down. And when NVIDIA did dive down, I sold a put that expired on with a $167.50 strike that expired on the 22nd at $443. All told, this is only what, about $140. So I was never going to get all this money back. But at the same time, I don't need to get all that back. I just need to get a little bit of money from a different stock and a little bit of money here. I'm not trying to get too greedy. The other thing is I really like to sell my covered calls and my puts. Anytime I sell something, I do it close to the expiration date. I really like doing that because what that does is it puts time on your side. Time, also known as theta. Theta is the enemy of those buying options, and it's the friend of anyone that's selling options. So you want to make sure theta is on your side. So I always sell short expiration date contracts. I also went ahead and I bought them to close for just $18. And then I sold a covered call for $65, bought it back for $17, and then I sold another covered call with a $200 strike that expires next Friday for $44. So in this way, I'm trying to get my money back little by little on NVIDIA. But the main thing I did at the very beginning was sold a covered call with a $185 strike and sold a put with a $167 strike. And that would be called a strangle. I did the same exact thing for Amazon. On Amazon, I lost $248 when being squeezed out of my covered call position. I'm currently only down $116 since the 20th of July. I did it by closing that out for $248, selling a covered call for $45, selling a put with a $118 strike for $33. I bought it back for $20, and I bought that one back for $1. And then again, sold a covered call, bought it to close, and sold another covered call with a $146 strike. After they reported earnings, it went up, and I thought, this is what's the most likely direction Amazon will go in after shooting up in a straight line? Probably down. But you know, you never know how far it's going to go up. So I went ahead and sold it well out of the money, $146, and I'm collecting $34 in premium. And last but not least, AMD. This one's like eating my lunch. These guys just won't stop going up. And so on these guys, I bought the close for $234, and now I'm down $277. But nevertheless, I stick to my guns. Same strategy. Sold a covered call for $40. Sold a put with an $85 strike for $27. Closed out my $40 covered call for $84. Thanks for that, AMD. and then sold another covered call for $49 with a higher strike. Closed that one out for $6. Closed out my $85 put for $4, and you get the point. So AMD is going up not only because of the fact that they're reporting earnings next week, but the thing that AMD really has going for them is the fact that Intel did so poorly on their earnings. And I think that the conventional wisdom is that old Intel customers are now flocking to AMD. And what I was really hoping is that people would miss that. I didn't think that they would catch that because honestly, these analysts seem to be a little bit slow on the uptake. And the other thing that they reported was that they have a big slowdown in their data center chips. And what we can see is that their data center and AI business revenues declined 16% year over year. And so who's taking that market share from Intel? It's not like it's going away, but AMD is taking the workstation personal computing processor away from Intel, and it's NVIDIA that's hammering their data center and AI business, as now data center has become NVIDIA's #1 source of revenue, overtaking gaming last quarter for the very first time. And I was hoping that Wall Street wouldn't clue into that because they generally don't, but this time they did. As Intel went straight down and AMD and Nvidia actually climbed. Usually they trade as a monolith. You know, the entire semiconductor industry trades as like one, like they're all doing the same thing. And as we said earlier, NXPI does automotive, onsemi does automotive, Nvidia does graphical cards with integrated chips that work primarily for gaming, but now they've expanded into data center using their ARM CPU processors. AMD generally does working with personal computing, and they're doing discrete chips and not integrated like graphics card chips and stuff like that. They're all completely different businesses. They're only tied together by the fact that they're all called semiconductor being something that conducts better than glass, but not as good as copper. I mean, that's all it means. But under the hood, they're all wildly different businesses with wildly different business models. Now, the next thing you can do is also a combination of things. You can sell a strangle at a future expiration date, would be a combination of number 3 and number 4. And I won't go into what that means. It's essentially the same exact thing as a strangle at the current expiration date, only you really are trying to get it all back right now. You're getting super aggressive, you're rolling it up and out. And last but not least, and here's one I never use, but it is one that I should use, and I'm going to start using it in the future. And that would be the buy upside protection. Why not buy a call to protect your upside? So let me show you an example of when I should have bought this, and I'm not going to do it now, but I really should have done it. Now here you can see that I'm currently down on my Microsoft position. If I want to buy my way out of this, it would cost me $360. Microsoft is not like UPS. UPS, if I don't buy my way out of this position, I make money. With Microsoft, I'm not making money. I bought it for about $315. My cost basis right now is about $309. So if I was to sell it at $280, I'm losing roughly $3,000. And I'm just not going to do that. Not on Microsoft. When I do my tax harvesting in December, I'll pick stocks to tax loss harvest, because I'll be danged if I'm going to be paying taxes on, say, what's going to be by December. I assume probably $12,000 or $13,000 in gains. I am not going to pay taxes on a losing year. I'm going to instead tax loss harvest, and I'm going to pick stocks that I want to sell to actually not have to pay taxes on my gains this year. But I digress. So Microsoft, I am not going to let this run to expiration and sell everything for $280 and only collect $44 of premium. I will be buying it out. Now, what I should have done was buy a call option against my underlying, against the selling the call option, essentially creating a credit spread. I should have done that when I noticed Microsoft was going up. However, Microsoft was down about $242 after reporting earnings, and this was just last Wednesday. And between Wednesday and Friday, it's gone up to $280. Do I really think that Microsoft's going to scream a lot higher from here? I don't think so. I think the risk is to the downside. If I hadn't already sold a covered call then, I would definitely be selling one now. And so I'm not panicking about this, but let's say I was panicking. Then what I could do, I could buy a call on Microsoft that would expire on the same day, and it wouldn't cost me a whole lot of money. And what this is insurance. It's saying that the most I'm going to lose on this covered call position is going to be the difference between the strikes, which is $500, plus what I paid, $173, which brings it to $673, minus what I collected already by selling the covered call, which is like $44. So let's just say, for the sake of argument, the most I can lose on this is $625. Now, if Microsoft screams up to $295, this thing could cost me about $1,500 to close out. But I have maxed out the loss that I can have at $625 by buying insurance against it. Now, I should have done this when Microsoft was down about $270. Right now, I'm going to throw the dice. I'm just going to let this thing run. At least by Tuesday, I'll reevaluate. And what I'll end up doing on Tuesday is, if this thing is just screaming higher, because I've already missed the window, I believe, to buy this call against this covered call position. But if this thing starts going higher, say into Tuesday, I'm just going to buy it out and just take the loss and go try and recuperate my money, just like I did in Nvidia, AMD, and Amazon. So those are my 6 strategies on the ways to get your money back should everything go kind of pear-shaped on your covered call positions and you're getting squeezed. There are ways to get your money back, and these are the 6 that I suggest that you go with. And now, for what we've all been waiting for, how can we profit from a dumpster fire? All right, so here's what I think is going to happen here. Coinbase has been going up, right? They've been going up because the whole market has been going up. They're up to like $63 a share. Now, we all know what's going on with these crypto exchanges. Terra Luna went down, taking Three Arrows Capital down with it, taking down BlockFi, Celsius, Voyager Digital. This whole thing's an unmitigated disaster, right? And so then Coinbase comes out and they say, hey, they're going to announce 1,100 layoffs as the CEO warns of recession and a crypto winter. It's not like they have a ton of employees working for Coinbase. 1,100 employees is 18% of their staff, and this is not a slowdown in hiring. This is a layoff. It's so bad that Cathie Wood decided to dump Coinbase shares for the first time. If Cathie Wood is dumping your stock, it is garbage, okay? Like, Cathie Wood will hold on to garbage with a kung fu grip. She will not let go of garbage, but even she dumped Coinbase. So this thing is going to be the ultimate dumpster fire. All right, so how do we profit from this dumpster fire? Well, what's going to happen is that Coinbase has been going up, like we said, with the entire market. On the 9th of August, they're going to be reporting earnings. Estimates are consensus $2.68 with a high of losing $1.44 and a low of losing $4.87. I think it could even be worse than this. This company is actually trading as though that they have a profit margin of 33%. Believe it when I see it. They may be doing better. Who knows? As all these other crypto exchanges go out of business and they're the only ones left standing, maybe everybody has to flock to them for their crypto delight. But I'm going to bet that this stock is actually going to go down. And so what I can do is I can buy a put that expires after they report earnings, so on the 12th, with a $55 strike, and I can buy it for $372. So what that would mean, in order for me to break even, Coinbase would have to finish at or below $51.28 by the 12th of August, and that would be $55 minus $3.72 a share, so $51.28. But how do I make it where there's no risk at all? Well, what I can then do is I wait, and I think that the market's going to cool off between now and, say, August 9th. As the market cools off, Coinbase may cool off a lot more. And then I'm going to start selling puts against it. But let's say it doesn't cool off at all, and let's say that on the 6th of August, it's still the exact same price it is today. So I'm going to sell 3 of the 45 strike puts for $375. So if I go over here and I go to put and then I go to $45, we can see that they're $125 a piece. If I sell 3 of them, that's $375. So the net win would be $3. So let's say that Coinbase surprises everybody and screams higher, right? It goes to $1,000. Well, I still win $3 because I bought this strike for $372, but I sold these for $375, so I win $3. So I have nothing to lose by it going up. If the stock goes down, and I suspect it will, I think 30% is a pretty steep decline from here. 30%, that would put it at the $44 price tag. If it goes down below $45, this is where I start losing money, because the one put that I bought will only cover 1 put that I sold. I still have 2 more puts that I sold. They're going to be heading down out of the money. So let's say it finishes with a 30% decline from here and the strike price is about $44. At expiration, you would say that's $200. But I'm not going to be saddled with these garbage shares. I'm going to be buying my way out of this contract. So I said it'll be $400 to get out of this contract, because not only am we going to be paying for the $200 of intrinsic value, I'm going to be paying extra money to get out of this contract. And that's going to cost me time and volatility. So I would say that my max loss with a 30% decline would be about $400, but my max profit is $1,003. That's the difference between the strike prices. That's 10, right? So that's $1,000 is my max profit plus the $3 I collected to begin with. So my max profit would be $1,003 and my max loss would be $400. Plus I got a chance to short Coinbase with no upside risk at all. All right. Well, thanks again for tuning into this channel. It's done a lot better than I ever thought it would. Thanks for liking and subscribing and hitting that little notification bell. Until then, we'll see you next time. Have a good day. Bye.
Rita agreed to participate in this experiment in exchange for dropping of certain criminal charges and a small fee. We did, however, have to come to an arrangement with her pimp, a gentleman who goes by the name Upgrade, which he spells thusly, with 2 Ds, as he says, for a double dose of this pimping.
Rita, you gotta understand that Upgrade's been dead for a long time now.
Yeah, man, but you said there was a time machine, right?
Yeah, there's a time machine now that can take us back to the past, but there was no time machine back then, so...
Upgrade don't care where the time machine is, now, then, last week. He will find a way to come get his money.